Welcome back to Smart Stock Sam, where we don't just follow the market, we get ahead of it. Before we dive in, let me ask you something. What would you do if we had spotted a stock quietly building a mechanical powder keg with nearly 60% in annual borrowing costs crushing an entire camp of traders, a shattered call wall, a sector ignited by a blowout earnings report from a completely different company, and Wall Street analysts boldly projecting a price target of $20? Would you have had the conviction to act before the explosion happened? Because that is exactly the setup Smart Stock Sam laid out for SoundHound AI, ticker SOUN, and on May 1st, it paid off in spectacular fashion with a single-day spike of over 20%. Today, we are going to walk through the complete anatomy of that trade, from the predictive model that saw it coming days in advance, to the mechanical feedback loop that launched it into orbit, all the way through what happens next, and whether this move has only just begun. Could this stock really be heading to $14, $16, or even $20? Stay with me, because by the end of this video, you will have a full playbook in your hands, including the exact levels to watch heading into a massive earnings catalyst. Here is where we begin. Imagine you are a short seller. You have borrowed shares of SoundHound AI, and you are betting that the price falls, but instead of falling, the stock starts grinding higher. And while it grinds, you are being charged an annual borrowing fee, not 5%, not 10%. We are talking nearly 60% per year, just to stay in that losing position. Every single day that passes costs you real money. That is the trap that was quietly being set for over 37% of SoundHound's entire float. More than 146 million shares were sold short. 146 million shares that would eventually, mathematically, inevitably need to be bought back. And when the trigger finally got pulled, those short sellers did not have a quiet, orderly exit. They had a stampede. But to understand why May 1st became the detonation date, we have to rewind and look at the precise predictive modeling that identified this opportunity before the crowd even noticed a thing. Smart stock. Sam had been tracking a tactical entry price of $8.19 on SoundHound AI. The logic was surgical. Short interest had climbed above 20% of the float, a statistically significant level that signals a vulnerable, overcrowded trade. A critical resistance ceiling had formed at $9, where market makers were heavily stacked with short call options. And the stock was coiling just beneath that level like a compressed spring, waiting for the right spark. On April 29th, the market tested the resolve of the bulls, dipping to a firm low of $7.58, staying cleanly above the stop-loss trigger at $7.50. The floor held. That was confirmation. Then came the setup day, April 30th. The stock closed up 3.2% at $7.96. But here is the detail that made seasoned traders raise an eyebrow. Volume came in at only 19.9 million shares, well below the daily average. In markets, abnormally quiet volume before a big move is not a sign of weakness, it is a sign of accumulation. Smart money was loading positions quietly, without tipping its hand. The spring was being compressed one final time. And then, Friday, May 1st, the explosion. So what exactly is a gamma trigger, and why does it turn a stock from a slow grind into a vertical rocket? Let me break this down simply, because this mechanical feedback loop is the core engine of everything we witnessed. It starts with an initial volume catalyst, buyers coming in, pushing the stock upward toward that $9 resistance. As the price approaches that ceiling, something fascinating and brutal happens simultaneously. Market makers who had sold $9 call options are suddenly at risk. As the stock threatens to break above $9, those market makers are forced to buy the actual underlying shares to hedge their exposure. Their buying adds fuel to the fire. The price breaks $9. Now, borrow fees, which had already tripled to 23.01% earlier in the week, explode to a peak of 61.78% on May 1st alone. The cost for short sellers to stay in their positions becomes unbearable. They begin covering, buying shares to close their shorts. That forced buying pushes the price even higher, to an intraday peak of $9.60. The fresh breakout triggers even more covering, which attracts more institutional buying, which pushes borrow fees higher still, a self-reinforcing loop of upward pressure with no natural ceiling, until the shorts are exhausted. This is the short squeeze anatomy in real time. Predictable, trackable, and exploitable, if you knew what signals to follow. Now every squeeze needs a spark, the one external event that pulls the trigger on all that compressed energy. And here is the fascinating twist. The catalyst was not even a SoundHound headline, it was Twilio. Twilio reported blowout first quarter results, and buried inside that earnings call was one critical detail that sent shockwaves through the entire voice AI sector, a 20% year-over-year increase in voice AI revenue. Think about what that actually means. An enterprise-scale communications company serving Fortune 500 clients globally just confirmed in hard numbers that conversational AI is not a future trend. It is a present reality generating real, measurable revenue growth right now. For SoundHound, this was powerful validation from completely outside its own walls. The market for their technology is not theoretical. It is expanding rapidly, and companies are paying for it. The sector-wide rising tide lifted SoundHound because investors immediately connected the dots. If Twilio is growing voice AI revenue at 20% year over year, what does that mean for a company that is entirely and exclusively built around voice AI? The answer showed up in the price action. 67.6 million shares traded hands, 151% above the daily average. That is not retail excitement. That is institutional repositioning at scale. But here is a question worth sitting with. Could SoundHound sustain this momentum on its own fundamentals, completely independent of sector tailwinds? The answer starts with one acquisition, LivePerson. SoundHound recently completed a $43 million equity acquisition, absorbing LivePerson's core conversational infrastructure. On the surface, that sounds like one tech company buying another tech company. But peel back one layer and you find something far more strategic. LivePerson brings with it direct existing relationships with 25 Fortune 100 companies. These are not leads. These are not prospects. These are paying enterprise clients with established integrations and budget allocation already in place. SoundHound is not knocking on corporate doors and pitching a demo. They are walking in as an already trusted vendor. This asset pipeline is the bridge to a projected revenue target of $350 million to $400 million by 2027. But acquisitions carry integration risk, and we will return to that when we reach the earnings watch list. Want proof the technology actually works at scale today? Look at Casey's General Stores. This is not a pilot program. SoundHound's AI voice agents are live and fully operational across 2,600 Casey's locations, having handled over 21 million customer interactions. That number matters because it answers the single biggest objection institutional investors have when evaluating early-stage AI companies. Does it actually work under real-world, high-frequency, consumer-facing conditions? The answer with Casey's is an unambiguous yes. That kind of at-scale validation is precisely what opens the doors to multi-year enterprise contracts with other Fortune 500 retailers who are watching very closely. So, who else is watching? The smart money. And they are not just watching, they are buying. Vanguard recently disclosed a new passive stake of 6.62%, controlling over 25.8 million shares. Rakuten Securities increased their total position by a staggering 877% during the fourth quarter alone. When one of the largest asset managers in the world takes a meaningful passive stake and a major international brokerage nearly decouples its position in a single quarter, that is a signal worth taking seriously. However, Smart Stock Sam does not sugarcoat risks. CFO Nitish Sharan departed the company abruptly for a role in quantum computing, leaving co-founder James Hom to step in as interim CFO. C-suite instability heading into a major earnings report is a fundamental risk factor that every investor must weigh carefully against the otherwise bullish setup. Do not ignore it. Now, let us run a full diagnostic on where the stock stands. The daily RSI is sitting at 82.8, deep inside overbought territory. Historically, readings above 70 signal the need for near-term consolidation before the next sustainable leg higher. This does not mean the trade is over. It means patience matters. On the moving average checklist, the picture is constructive. The stock is trading above its 5, 10, 50, and 100-day moving averages, a clean sweep of near to medium-term trend indicators. But there is one stubborn ceiling remaining, the 200-day moving average, sitting in the $10.55 to $10.90 range. Reclaim it on strong volume, and the technical setup becomes explosive. Fail to hold it, and you have a failed breakout, one of the most punishing patterns in all of technical analysis. And the people who need that ceiling to hold? The short sellers, who remain trapped in one of the most painful environments imaginable. 37.59% of the float is still short. 146.6 million shares that must eventually be repurchased. Days to cover sits at 5.29, meaning it would take more than a full trading week of average volume just for shorts to exit in an orderly fashion. There is nothing orderly about a squeeze. Active borrow fees of 58.20% mean the clock is ticking loudly for every short seller still holding. They are paying nearly 60 cents on the dollar annually just to stay short. The question is not whether they will cover. The question is when, and whether earnings on May 7th gives them an excuse to stay or a reason to flee. The options market already has an opinion. Unusual activity was concentrated in the $11 calls expiring May 8th, the day after earnings, ranking number 1 in options turnover on May 1st. Traders are making loud, aggressive bets that SoundHound breaks above $11 in the immediate aftermath of the earnings call. Wall Street analysts are even more aggressive in their targets, with an average price target of $14.93. H.C. Wainwright sits at the absolute top of the range with a bold $20 target, implying more than double from current levels. What would need to go exactly right for that to happen, and what could still derail it? That brings us to May 7th, post-market. The Q1 2026 earnings report is the defining catalyst that either validates everything discussed today or introduces a painful reality check. Three things matter above all else. Revenue trajectory must confirm the path to that $350 to $400 million 2027 architecture. Management must address the LivePerson integration directly, specifically the friction level and revenue contribution timeline. And forward guidance on enterprise adoption needs to show SoundHound is capturing the wave that Twilio just confirmed is completely real. Miss on any of these three, and that overbought RSI becomes a problem very quickly. For the trade setup heading into earnings, the former $9 resistance has successfully flipped to become the new psychological support floor. A tactical pullback entry near $9 represents the optimal risk-reward setup for new positions. The first target resistance zone sits at $10.50 to $11, the critical battleground for reclaiming the 200-day moving average. Clear $11 on high volume and the technical ceiling effectively disappears, opening a direct path toward the $14 analyst consensus range. The four-step pathway looks like this. Confirm revenue growth on May 7th. Generate bullish technical volume through the $10.90 moving average. Trigger final forced capitulation from short sellers paying 58% borrow fees. And let the resulting squeeze acceleration carry the price into the $14 to $16 Wall Street target range. Could it extend to $20, as H.C. Wainwright suggests? That requires execution beyond even current projections. But in a genuine short squeeze backed by institutional conviction, stranger things have absolutely happened. Now, before the final wrap-up, Smart Stock Sam has a critical reminder for every viewer. Nothing in this video constitutes financial advice. All content here is purely for educational and informational purposes. All investments involve risk, including the complete loss of principal. Past performance does not guarantee future results. Short squeezes can reverse violently and without warning. Always conduct your own independent research. Consult with a licensed financial advisor before making any investment decisions, and never invest more than you can genuinely afford to lose. Markets reward preparation, not impulse. So here is where we land. SoundHound AI delivered a textbook short squeeze on May 1st, a 20% single-day breakout driven by a shattered call wall, 61% borrow fees, Twilio's sector ignition, and over 146 million trapped short shares. The fundamentals are scaling with the LivePerson deal targeting $350 million and beyond, and Casey's proving the technology at 2,600 real-world locations. The next major inflection point is May 7th earnings. The technical gate is $10.90, and the ultimate prize, if everything aligns, sits squarely in that $14 to $20 analyst target range. Now here's the question I genuinely want your take on in the comments. Do you believe SoundHound AI can sustain enough institutional conviction to force a full short capitulation before the 200-day moving average even becomes a factor? Or does the abrupt CFO departure create just enough of a confidence ceiling to keep the bears in control long enough to shake out the latecomers first? I read every comment and I respond throughout the week, so drop your answer below right now. If this breakdown gave you a real edge today, please hit the like button. It takes 1 second and it genuinely helps Smart Stock Sam reach more investors who need this kind of analysis before the move happens, not after. If you are not yet subscribed to this channel, hit that subscribe button and turn on notifications. We are building something special here, and you absolutely do not want to miss the next setup before it moves. And if you want to go one step further and directly support this channel, YouTube's Super Thanks feature makes it easy. Every single contribution goes right back into the research, the data, and the production quality that makes these videos possible. Thank you so much for watching, stay disciplined, and I will see you in the next one.